Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, this is David Blake. This is Tech Talk Tuesday. If this is your first time attending, I want to thank you for joining us. I was out of town last week traveling, so we didn't get to do this. But if you're new, we generally talk about 20-25 minutes, look at some different charts and the sectors. Also today, we want to talk a little bit about the financial stocks and specifically which ones, if that's just a sector that you want to go into blindly, or if there's some certain areas of the financial sector that you want to put into your portfolio at this time. So since we only have about 20 or 25 minutes, at the end of that time period, you all can ask questions about individual stocks or things that we spoke about during the meeting, or even different sectors, whatever's on your mind, and we'll try to go over it. Okay, just briefly, we try to wrap up what happened the previous week on these things first, and that was last week. Major averages basically had the worst week since August. Dow Jones was down almost 600 points. We lost 3.3%. S&P 500 was down 3.8, NASDAQ 4.1, and underperforming again was a small cap index to Russell 2000. It was off 5.1%. The Dow Jones Transportation Index also broke below the, actually made a new 52-week low. It fell 5.4%. So we talk often about the Russell 2000, the Dow Jones Transportation Index. It's going to be hard for this overall broader market to make a lot of headway without participation from those two indexes. Also, we had the NASDAQ, S&P 500, and the Dow break back below their 50 and 200-day moving average, which is a negative. But the first thing I want to look at before we go to the charts is we talk on here often and in the market letter about how thin some of these market rallies are, especially the one that was going off of the all through October. We had the 6-week rally. This is updated as of yesterday, and this is the NYSE Advanced Decline line. It's a leading indicator which shows you how the broader market is participating in a rally. Now, even with somebody has a thing up here saying, "Is there anything going on?" Could you not hear me? Can someone type yes if you can hear me? Okay, great. Sorry. All right. Well, even with yesterday's rally of about 105 points, on the advanced decline line, it was 2-to-1 with declining issues beating advancing issues. That's not what you want to see on a market bounce. As you can see over here, the last couple of days have been quite bad. The last week or so, a lot of distribution going on in the market. Of course, we had this little no audio. According to my stuff, it should be working. We can hear you fine. Okay, just some aren't coming through. All right. Well, anyway, so here we are the last couple of weeks of this pullback on the broader on the market. We've made another new low. We had a double top up here, which and these also you can look at these just like a regular chart. You have a double top up here. You're not getting as much participation. It rolls over. We want to watch. We want to watch now to see if this thing's going to hold down here around 312. We've lost about 10,000 units just over the last 2 or 3 weeks on the NYSE. Not what you want with a strong rally. Now, worse, here's the NASDAQ advanced decline line. And yesterday, again, you had more than 2-to-1 declining issues versus advancing issues, and you took out the low from back here in October. Again, this is a leading indicator, which doesn't bode well for a broader market rally in here. And that's so that just shows you the thinness that we have in this. We've talked several weeks about you have the FANG stocks, like Kramer calls them, the Netflix, Microsoft, Apple, Facebook, Google, Alphabet. These are the stocks that are actually, pulling this overall thing up. So that concerns us. Another thing that concerns us is the NYSE new high, new lows. You want to see some wider participation. Unfortunately, yesterday With that rally, you had 5 new highs on the NYSE. You had 632 new lows. That's not a broad-based rally. And last time we had anything close to that many new lows was on August 24th, where we had about 1,100. Okay, you look at the NASDAQ. Again, you had 19 new highs and 312 new lows on the NASDAQ. Again, showing that you had a very small participation in that rally. Today's better. The internals are actually pretty good today. But just in general, this isn't a, Katie bar the door, jump in and buy everything. So this is more of an oversold bounce. And we're going to go into some of the things that we look at to determine whether this is oversold, the market's oversold. Okay, here's the Dow Jones. We broke below the 50 and 200 day. You now have a declining trend line up here. Today's market has us back up here at 17,563. So you had what you'd expect. You came back up here to the 50 and the 200-day moving average. You've kind of stalled out over here. You actually had a sell signal coming in the last day or so on the MACD long term, which is a longer term, intermediate term look at the market. So that has gone negative. Like I said, we're stalling up here right at the 200 today. We'll see what happens tomorrow. I do think you might get some carryover with the Fed thing, but we'll talk about that at the end of the talk here. Same thing with the S&P 500. You broke below. Actually, this is the Dow Jones on a weekly chart, which actually looks a little bit better. But you still have stalled up here below the 50-week moving average, and that's coming in right around 17,580. That's right about where you've stalled on the weekly chart also. So this looks like you have a little bit more work to do in here. We were unable to break out to the new highs here over just about a 5 or 6 week period. We want to watch that. But you're not oversold on the weekly chart yet. And you also have some improvement in the MACD long term. And this is going to look out, probably a month or so. So it's not like we're just rolling over completely. I think you'll find your support levels back down here probably around 16.8 if we roll over here in the next couple of days again. Okay, S&P 500. Now you did take out your mid-November lows over here intraday yesterday. A lot of this rally was based off of the turnaround in oil. I think oil broke below $35, and once that started to come up, you had some big gains in Exxon and Chevron, which were up 3.5% or so yesterday. That pretty much pulled the whole market up with it. And you also have it's not just an oversold oil rally. You have a lot of analysts out there projecting that once they raise rates tomorrow, you could get a relief rally just because it takes out a little bit of uncertainty into the market. If she doesn't raise rates, I think you'll probably see this thing get hammered. But all indications are that they will. Even the inflation numbers that came in this morning supported the rate hike also. I think if you looked at the core, it was up 2%. That's what they're trying to get. But again, the underlying indicators are weak. Momentum is still very weak on the S&P 500. MACD long term has also given a bearish signal. So I think you've got some more work back and forth in here after we get a little bounce tomorrow. NASDAQ, same thing. You broke down yesterday below your mid-November lows, which is a bearish sign. You've bounced up here today to 5,005, which is right here with a 50 and 200 day are kind of splitting off right in that area. So, like I said, I expect probably with the NASDAQ, I would think you could get a bounce back up to about 5130 tomorrow. I would think on the S&P 500 on an oversold bounce and a Fed rate hike, you could get up to around 1990. I'm sorry, you could get up to around 2090, maybe even 2100 on that. Okay, over here we want to look now at the Russell 2000. That's a pretty ugly looking chart again. Even with that rally yesterday, it sold off with the Dow Jones Transports again. So without the participation of the Russell 2000, you're going to have a hard time breaking out the new highs. Today's rally has you back up about 8 or 9 points to 1124. So you're not even where you were at the start of Friday back there. Very oversold. This is a 30-day stochastic, which I like to look at. Even on that, you're really oversold. MACD is still bearish. Momentum's down here, probably around the 14-day RSI, somewhere around 20. So again, Russell, I don't see anything more than just an oversold bounce. Here's the transports. You actually made a new 52-week low yesterday. This is a 2-year chart. I think the transports are probably, worst case, probably coming down here around 7,200 if we roll over on some bad economic news or some bad news out of China or something like that. I think that would probably be where you would find support on the longer term on that one. Okay, let me take a look at it real quick here. Okay. Next chart, we'll look at the sectors real quickly here before we go into some of the financial things. But before we go into that, there's a couple indicators that we put out there that you may want to look at when we say the market's oversold. You can look at your 14-day stochastic or something like that. That's most analysts aren't looking at that. One of the things that we look at, we want to see how many stocks are trading within 2% of their 52-week lows and 2% of their 52-week highs. That will tell you how broad-based the market is, or how many stocks are just rolling over, falling out of bed. As of the close yesterday, after that rally, we had 4.6% of the stocks that we're following in our atmosphere we have here were within 2% of their new highs. That was it. At the August lows, that got down to about 3.75%. Okay, and what you're looking, when you get at that number, we only have about 7% to 10% within 2%. That means the general market is oversold, and you're probably due for a bounce, which we got today. Now, when you're looking, are we ready to take off in this market? When you have 4 or 5% stocks making new highs. We had 31.3% of the stocks yesterday at the close were within 2% of a new low. That means, again, any of these little bounces are really, really thin. In this case, it's the big name cap stocks, the Microsofts and Googles and stuff. Okay, we got down to 40% of the stocks were within 2% of a new low on August 28th. So when you get down to that type of level, you're usually going to get a good bounce. But it's also always a red flag when you have less than 12, 13, 14% of the stocks up near the old highs. Okay, another thing that we want to look at for an oversold indicator, Jim Cramer talks about this once in a while, is we want to see how many stocks are trading above their 10-day moving average. And we track this every day. When this gets down to about right around the 10% level, you can almost back up the truck and guess again, and you're going to have a sharp rally. Okay, after yesterday's close, it had gotten down to we had 10.1% of the stocks that we follow were trading above their 10-day moving average yesterday. Boom, you came in today, you got a 200-point rally. Now, can you play that? Certainly. The problem is the futures had you up about 180 points this morning right at the open. So if you were going to buy some options, it was a little bit tough to get in. I think you'd have overpaid for them. But knowing that if we would pull back today, there might be you still are due for a bounce in this market, and usually you get a couple good days. It's not like a 1 or 2 day trading range. So I would expect this thing probably to rally, maybe even into Friday, off of these indicators. Okay, quick run now over the sectors. Here's the materials sector. We haven't liked that for quite a while. We couldn't break through resistance up here. Going back into October off the lows, kept getting up to the same area around 46, and we couldn't break through it. Rolled over, broke down below the 50-day yesterday. Found support at 43. As far as today, we are getting a little bit of a bounce on that. You're up about 38 cents to 43.50. That puts you back up right about here. Not much of a bounce in that sector. We still don't like the materials. Basically, they're getting hindered by China's slowing growth, and also as the U.S. dollar continues to strengthen, the materials aren't going to go anywhere, especially with the copper prices and all that, and even the natural gas will go into this. The energy, okay, this is actually kind of getting a little bit interesting because we've been telling you that if you're going to buy the oil stocks, you can get them for a bounce. I think you're probably going to get another bounce right in here. You're up 2% today to 37 on crude oil. But this is the third time we've come down here and tested this level on the energy sector. And also, it looks to me like the crude oil probably could be bottoming out down here in this 34 to 35. I think if you're looking for a trade, you can nibble away at some of the bigger cap names. I'm not really interested in the small cap oil sector stocks. I just they're going to have some trouble with their debt, and you're not sure how many of them are going to be able to weather the storm. But your Chevrons and your Exxons, you can still get some pretty decent trades in these things. If we come back down here and break it, of course, you want to get back out. That means you could go to the high 20s. But I think you're probably going to find the bottom in this oil and the energy sector right in this area. So I would consider starting to pick up some stocks in that. Here's the USO, which is United States Oil Fund. Again, you made a new 52-week low over here yesterday early, and you bounced back. You've got a little bit of a bounce in here today. Has a gap up here. If you get some momentum going, you could maybe fill that gap up on this USO, which would get you up around $12.50, $13. So that might be something. But more important than that, okay, all this sideways motion over here, you saw a lot of accumulation. But now, starting back here about mid-November, you're getting a lot more selling, and you actually are, coming down. This indicator, which measures over the last 50 days, is something when you're going to go into this thing for the longer term. You want to keep an eye on that because it's going to show you. You can have these analysts on TV saying, "I think we're at a bottom now. I think we're at a bottom now," but they're not saying it with their money yet, because you can see we were at 1.3 over here in November on the up-down ratio. We're down now over here about 0.6. So, like I said, they may be calling for a bottom, but they're not putting their money up yet. And until you see this thing start to move up, that's when you know that maybe some big money is starting to move into these into that sector. Now, if you were listening on here earlier in the year, we talked often about if you go back to 2009 and draw a long-term trend line on energy, when this thing when a sector or a stock breaks a long-term trend like this, you want to be out. That means possibly something fundamental is going on with the stock. We didn't know what was going on with the energy at that time. But you can see here it came back up to that trend line, bounced off it, came back up here on the trend line, and bounced off it hard, and came down here and started making some new lows. So you can see where the accumulation distribution was on this also. But we're under a distribution again. But again, here comes that triple bounce that we're looking at, the triple bottom, which tells me that as long as it holds above this 60 area, you may get another little bounce in XLE, which I think will probably be due to oil starting to find a bottom. But anyway, when you have something like this, you just want to be out there and you can start shorting a stock or sector at this area right here. Okay, financials. We've been talking about this. You had a nice run over in here off the September lows. We talked a week or two, about 2 or 3 weeks ago, that you may want to start taking some profits in financials. And the reason I'm saying that is because, number one, I don't think a quarter point interest rate is going to be that great for their profits. Number two, the banks are going to make their money off of a widening yield spread. When you look at the 2-year and the 10-year, and you're getting they're coming back together on the yield spreads, and that's telling me that the longer term, that the market doesn't think that we're really ready for a bump up in short-term rates yet. They're not sure the economy is going long. So if you see the yield spread starting to come together between the 2 and the 30, that's telling you that you probably want to roll over and maybe take some profits off it. Although we've had this pullback here over the last week or two after we talked about taking profits up here. You've come down here and you're looking at finding support at 23. So you're probably going to get a bounce back up in this area, but I would probably take some profits in some of the bank stocks at this time and see how the broader market's going to perform after we get the rate hike. Industrials, again, you had quite a big pullback from this. I don't particularly like the industrials, mainly because, especially the big conglomerates that have a lot of international exposure. I think there are pockets here in the United States. We talked a few weeks ago about some of the Raytheon, United Technologies, some of these stocks that are making guns and some of that stuff that have a lot of their sales domestically. I think they're going to perform well, but your Caterpillars and companies that get a lot of their sales from overseas, I'm not a big buyer of those. I think they're still going to have some problems for a while. They may be cheap, but they can always get cheaper. So the industrials, I would be selective on these. What I do like about this is that you still see the up-down slope still moving up on that. So they're under accumulation. That generally is a sign that your hedge funds or your money managers are buying some of the industrials. Okay, technology, still my favorite sector. My only problem, you have a nice up-down ratio in this. My only problem is that while you're over here making new highs in the technology sector, it was by a handful of stocks that were making new highs. That was your Microsoft and your Google and Facebook and that. Your Philadelphia semiconductor, semiconductor stocks are not supporting that this is always to a new high. Today you have 38 cents. So you've got a little bounce up here. You're bouncing around the 50-day. But this is still, if you're going to be buying things, I still like the technology sector going forward. We have the consumer staples, another defensive sector. Had a nice bounce yesterday. You have a nice bounce today. I like this sector. As far as what's in here, you have food, you have beverages, you have cosmetics, personal care. And over the last 4 weeks, this is a picture from our Market Edge industry group analysis. And you're starting to see a lot of these groups roll over. But what I wanted to check was what, just over the last 4 weeks, is outperforming. And that you have this household products, non-durable, you have food, you have beverages, food retailers, internet retail, which we have talked a little bit about, specialty retailers, which we talked about. But other than that, over the last month, every other industry that we track is down. So again, that also is showing you that this is a really thin advance in the market, not something that you want to go in. It doesn't look to me like we're building a base in here to break out the new highs. Okay, here's the healthcare sector. I like this over the longer term. You can't quite bust through this 200-day moving average for some reason. I think a lot of that is due because of the biotechs and also because of the pricing issues on some of the bigger healthcare stocks. They're having some problems with that, but they are under accumulation over here, and I think at some point they're going to break out. Now, if you looked at a longer-term chart on the healthcare sector, you don't have a breakdown like you had in the energy sector. You're still well above the longer-term trend line in healthcare. So on these things, I would be buyers of this in the pullback. Okay, next we have here it is over here. Here's the long-term trend line in healthcare. So you've got a long ways to go before you're breaking the long-term trend. I'm not saying there's something wrong with this sector. So I would be buyers of this on a pullback. Okay, lastly we have the consumer discretionary. And again, this is done well. It's found support at the 200-day moving average the other day. We've been talking about this the last couple of weeks. Pockets of strength in this. If you have your Home Depots, Ulta Salons, Costco, Dollar Tree, Dollar Store, these stocks have done quite well. My only problem with that right now is I think that some of those stocks especially off of the lows of October, the Home Depots and stuff, some of those are up 20-some%. I think I wouldn't be chasing them right in here because I'm not so sure. I don't think the broader market's going to take off in here and start making new highs. Some guys think that once we get the rate hike, you will, but I think you stalled up here before with the broader indexes. I think you may have still have some problems getting through that to make new highs. I think they'll see how this rate hike pops in here. Okay. Like I said, I promised that we were going to try to talk about some of the financial stocks that you may want to go into. We're running out of time, but I do like some of the bank stocks. I do like the online retail stocks, especially the stocks like TD Ameritrade, Schwab, E-Trade. Your bigger banks and regional banks should do well. I would buy them. I wouldn't chase them in this environment. Like I say, when you have analysts coming out and saying you need to be in the financials, and then you see a chart that's rolling over here, okay, well that's we're talking about taking that's the consumer discretionary, but the financial looks something like that too. I would not want to chase these bank stocks on a rate hike. Other stocks that do well with the rising rates would be your Prudentials, your Travelers, your Allstate, your different insurance stocks. even the brokerage firms like Morgan Stanley and Goldman Sachs, money managers like BlackRock, stocks like that. I think you could be going in here. I'm actually looking at some of the questions right now, like with Bank of America. We'll look at that in Goldman Sachs here in a minute. I like them. They've had a nice pullback in here. They were, on anticipation that Yellen was going to raise rates about a month ago. They were close to making 6-month highs, and that they did have a nice pullback. So we'll look at those in a minute. And finally, the last thing I want you to take a look at when you're starting to own these bank stocks or some of the financial areas. Keep an eye. You can go to, I don't care whether it's the Wall Street Journal or Finance Yahoo, whatever. Keep an eye on the 2-year and the 10-year yields, because when you see a flattening of the yield curve, that's going to cut in on the profits for the banks, and that's something you want to keep an eye on. If the yield curve actually starts to get inverted, of course, that's telling you that within 9 months or so you're going to go into a recession. But right now you're getting a flattening of the yield curve. That makes me cautious on the financials. Until you start to see an expansion in that, I would not chase these. I think you can get a bounce over the short term just because everyone's recommending them. But when everyone's on one side of the trade, again, I would be cautious on that. Okay, we're going to go over to the charts right now and take some questions. We have, say, Goldman Sachs, Bank of America. We got Europe. Let's see what else we have real quick. Okay. Turn this. Now this. Okay. Let's take a look first at Bank of America. Okay, right over here, I was telling you, you had a heck of a run off of the lows with Bank of America. Again, right about this point is where you started to see the yield curve start to come together a little bit. You had a chance down here yesterday to get it at 1650. I think you're up here around 1680, 1690 today. You're getting a bounce off of this. I think you can probably get a trade in Bank of America up here to maybe in the mid to high 17s again. At that point, but I wouldn't chase it after that. Look at your MACD long term over here. You got a sell signal on that. Your momentum is slowing down. I think that this run right in here on the bank stocks was probably the majority of it. You've already retraced about 50% of the move on Bank of America. A quarter point hike isn't going to add a heck of a lot to their earnings, especially with the flattening of the yield curve. So be careful on these. If you get them up here, I'd be looking to probably sell them rather than chase these things to new highs. Look at Goldman Sachs. Okay, again, over here you've had quite a rollover. You're down here testing the old lows from mid-September. Will it get to $200 in the first quarter? Depends how much underwriting business they do. Again, the quarter point's not going to make a heck of a lot of difference. You're probably going to get a trade to these things. I would look to trade out of Goldman Sachs up here around 188, 189, maybe a little bit higher than that, and then I think you'll probably stall along with the rest of the market. And the only thing that would make me more bullish on this would be because of the Fed's Yellen's probably going to come out here and say that we're going to raise it a quarter point, and that's it. If she does a one and done kind of rhetoric and sells that to Wall Street, that we'll look at raising rates again maybe in September. Then you've got another floor into the market, and you could see something going on. But I'm not so sure that after the initial rally, I think if it gets back up and stalls out like we just did here a couple weeks ago, I'm not so sure the market's going to be able to punch through it into new highs. But we'll have to see on that. Again, like if she can really deliver on a one and done and puts a floor under the market again like we had last year, we'll have to see at that point. But I don't see. I would trade out of Goldman Sachs up here if we can break through the 50. If we can get up here around the 200. Let's see over here. You were right about a lack of a Santa rally so far. What does the beginning of 2016 look like? If we don't get the Santa Claus rally, I mean, like I said, I think I'm looking for stocks to probably move up the rest of the week here a little bit. I do think January you'll start to see a little bit of a move up. I'm not so sure we're we're off to the races again. But I would if we pull back on this any further in this area, especially if you see with the see some bottoming coming in on the Russell 2000 and the Dow Jones Transports, that's gonna ring the bell to me that perhaps we can maybe we can start to work our way higher. But I don't see something that's going to ignite us to a new rally. Earnings are still, in fact, I think they still right at this point are considered to be negative for the first quarter. I think that'll probably change. I think we may be able to squeeze out to break even or so, but they're not going to be up by 2 or 3%. Neither are revenues. In fact, the fourth quarter revenues are supposed to be negative also, which will be in the third quarter of that, and you may have a third quarter of revenues or of earnings negative too, and that's not what you want to see making to a new high. Okay, any more questions real quick? Utilities. We'll take a look at the XLU. Okay, here's the 1 year chart for that. A one and done on a quarter rate hike. You could probably, you're down here bouncing off the lows. You could probably get yourself a little bit of a rally. I think it could also happen to dividend stocks, like the AT&Ts and even Intel's almost a dividend stock now. It's paying around 4 or 5%. That would probably add support to some of those stocks because if you're looking at now you get a 0.25% interest rather than 0. I'm not sure I'm going to want to trade in my 6 or 7% AT&T yield for a 1/4 point CD or a 1/2 point CD. So utilities, again, if she delivers a one and done, they probably bottomed in here. I wouldn't be afraid. You're not going to have this pullback over here which you had early in the year. So utilities, I'd be lukewarm on. I'd be buying them for the yield and not for growth. Don't forget about Europe. VGH. Okay, this is a Vanguard European ETF. You can see this also has taken a move south. Here's the up-down ratio. It's under distribution again in here. Part of this, I think, is due that you may see another pop in the dollar, which is going to hurt things. But with Europe, my problem is, okay, you're down here maybe making a double low from the October low. We've talked about a couple times. If you're going to buy the European ETFs or funds, make sure you buy the leveraged ETFs. You do a little bit of research on that. I don't have the names of them right here. I probably should. But if you don't buy the leveraged ETFs, when you buy them, if you buy those ETFs in Europe with $1, when you cash those in, you're going to lose 3, 4, 5% of your money just on currency conversion. So I mean, you have Mario Draghi going to do all he can to prop up the European economy. So it's probably a place that you want to go for the long term. Short term, I don't see a heck of a lot going on. He kind of disappointed people when they were expecting him to do more. So we'll have to see. But if you are going in there for the longer term, because they're at minus rates, make sure you get the leveraged ETFs and not just what do I mean, hedge versus leverage. Okay. You can go on here by that VGK, that Vanguard ETF, European ETF. It's priced in U.S. dollars. If you go on, do a Google search for leveraged European ETFs, it'll allow you to buy these ETFs in Swiss franc, in euros, meaning that when you sell it, you're getting your money in euros. You're not going to have to convert them back into dollars and lose the conversion rate on that. So Again, that can be a heck of a lot of your. It can mean a difference between, maybe 5 to 10% on your return. So, hedged or not leveraged? Oh, I'm sorry, hedged, not leveraged. Yeah, my bad. You want hedged. So you're hedging against the U.S. dollar increases, and not leverage. Leverage would be you're buying options and you have on your positions. That's not what we're doing. Hedged. Thanks, Stephen, for that for bringing that up. Okay, we have one more message coming in here. Someone was typing. I didn't see anything. Okay. Looks like that's all we have time for right now. I appreciate you coming in. There will be a link on this, probably MLPs. Are you okay with? If you'll send me an email to the doc@marketedge.com, I'll take a look at them. I'm not real big on the MLPs. I know you're getting the big yield, but I'm not so sure that's the place I want to be. But we will have. Okay, they were blitzed. Yeah. Okay. Again, you can send me something to look at, but that's not a place where I'd like to be to work on. So anyway, if you have something, send an email to the doc@marketedge.com, and we will see you next week. And I appreciate you taking time to take a listen. Thank you.